Before we begin, a quick and important disclaimer. This video is for educational and entertainment purposes only and does not constitute professional legal, financial, or tax advice. The historical trends and data points discussed are based on complex socioeconomic variables and should not be used as a basis for personal or professional decision-making. Divorce laws and economic conditions vary significantly by jurisdiction and individual circumstances. Viewers are strongly encouraged to conduct their own due diligence and consult with qualified legal and financial professionals regarding their specific situations. Imagine a structural shift so profound that it redirected the flow of trillions of dollars within the United States economy, altered the very architecture of the American housing market, and fundamentally redefined the labor force participation of more than half the population. We often discuss divorce as a social tragedy or a personal liberation, but we rarely analyze it for what it truly is. One of the most powerful economic catalysts of the 20th and 21st centuries. In 1960, the divorce rate in the United States sat at approximately 9.2 per 1,000 married women. By 1980, that number had skyrocketed to 22.6. This was not just a cultural revolution. It was a total reconfiguration of the American household as an economic unit. We are currently living in the ripples of this explosion, where the transition from a single income, two-parent household to a fragmented, multi-household economy has created entire industries while simultaneously hollowed out the middle-class safety net. Over the next 10 parts of this masterclass, we are going to dissect the cold, hard math behind the end of "Till Death Do Us Part." We will explore how the legal shift to no-fault divorce in 1969 became a massive, albeit unintentional, economic stimulus package, and why the modern singles economy is now a primary driver of U.S. GDP. If you have ever wondered why the cost of living feels impossible on a single salary, or how the dissolution of the nuclear family paved the way for the modern gig economy and the rental crisis, you are looking at the historical trends we are about to uncover. This is not just a story of broken homes. It is a story of how the United States learned to monetize the end of the American dream. The problem this deep dive solves for you today is one of clarity and strategic positioning. By understanding the historical intersection of marital stability and economic cycles, you will gain a clearer perspective on how asset allocation, labor value, and housing demands have shifted over the last 60 years. Whether you are navigating your own financial future, analyzing market trends, or trying to understand the macroeconomic pressures on the modern American family, this analytical history provides the data-driven context that is often missing from the public discourse. To understand where we are, we must go back to the baseline of the mid-20th century, an era often romanticized as the golden age of the American family. Between 1945 and 1960, the U.S. economy was built on the foundation of the production-consumption unit of the nuclear family. In this model, the husband typically functioned as the primary earner, specializing in market labor, while the wife specialized in domestic production. Economists like Gary Becker, who later won a Nobel Prize for his work on the economics of family, argued that this specialization was highly efficient for the era. By dividing labor, the household maximized its total utility. The man increased his human capital in the workforce, and the woman managed the household capital. However, this economic efficiency relied on a crucial, often overlooked legal pillar: the fault-based divorce system. In the 1950s and early 60s, obtaining a divorce in most U.S. states required proving fault, such as adultery, abandonment, or extreme cruelty. This created a high barrier to entry for the divorce market. From an economic standpoint, this meant that marriage was a high-stakes, long-term contract with massive exit costs. Because the exit costs were so high, the economy was remarkably stable at the micro level. Real estate was developed for long-term ownership, and consumer goods were marketed to a single stable household unit. But this stability masked a growing economic tension. As the 1960s progressed, the opportunity cost for women staying out of the labor force began to rise. Technological advancements in the home, washers, dryers, and processed foods, reduced the time required for domestic production, effectively creating a surplus of labor within the home that the U.S. economy was eager to tap into. The true turning point arrived in 1969, when Governor Ronald Reagan signed the California No-Fault Divorce Act. This was the first domino to fall in a legislative wave that would sweep the nation. No-fault divorce effectively changed the legal definition of marriage from a permanent contract to an at-will partnership. The economic implications were immediate and staggering. When you lower the cost of an exit, the frequency of that exit inevitably increases. Case studies from this period show that as states adopted no-fault laws, divorce rates didn't just climb, they doubled. This legal shift triggered a massive reallocation of assets. Under the old system, the innocent party often held the leverage in financial settlements. Under no-fault and the subsequent shift toward equitable distribution or community property, the math changed. We saw the birth of the divorce penalty. For many women of that era, who had spent decades specializing in domestic production rather than market labor, divorce represented a catastrophic loss of economic security. Data from the 1970s suggests that in the year following a divorce, a woman's standard of living often dropped by more than 30%, while a man's standard of living, freed from the costs of supporting a full household, could potentially see an increase despite alimony and child support payments. This discrepancy created a new class of economic actors, the single working mother. The entry of millions of divorced or soon-to-be divorced women into the workforce in the 1970s provided a massive influx of labor. This helped fuel the growth of the service sector, but it also fundamentally changed the supply and demand dynamics of the labor market. As the two-income household became the new standard for economic survival, the singles economy began to take shape. This is the phenomenon where one household, which previously required one set of appliances, one roof and one utility bill, is split into two. From a GDP perspective, divorce is actually a growth driver. Two smaller households consume more than one large one. They require two refrigerators, two sets of furniture, and two separate rent or mortgage payments. Consider the housing market. In the 1950s, the demand was for the suburban starter home. By the late 1970s and 1980s, the market had to adapt to a massive surge in demand for apartments and smaller housing units to accommodate the fragmented family. This shift contributed to the urbanization and condofication of American cities. We also see a shift in intergenerational wealth transfer. When a family remains intact, assets are concentrated and passed down. When a family splits, those assets are often liquidated to cover legal fees and the costs of establishing a second residence. The divorce industry, comprised of lawyers, mediators, real estate agents, and therapists, grew into a multi-billion-dollar sector of the U.S. economy. As we move forward in this series, we will look at how these historical trends evolved into the Great Recession and beyond. We will examine the silver divorce trend of the 2010s and how it is currently impacting the retirement security of baby boomers. We will look at the marriage premium versus the bachelor's tax, and how the U.S. tax code has struggled to keep up with the reality of the modern American lifestyle. The evolution of divorce is the evolution of the American economy itself, a move from stability and specialization to mobility and fragmentation. Understanding this history is the first step in decoding the financial reality of the 2026 landscape. To understand the financial reality of the 2026 landscape, we must analyze the pivotal era where the American household transitioned from a single-earner model to the dual-income trap. By the mid-1980s, the economic shockwaves of no-fault divorce had settled into a new permanent feature of the U.S. economy. This was no longer just a legal anomaly. It was a macroeconomic catalyst that fundamentally altered the labor market and consumer credit. Imagine a woman named Sarah in 1985. She is 35 years old, living in a suburb of Atlanta. Like many of her peers, she spent the last decade specializing in domestic production. When her marriage dissolves under the no-fault laws established just a decade prior, Sarah is not just losing a partner, she is entering a labor market for which she has no current resume. Sarah represents the historical trend of the displaced homemaker, a demographic that became so significant that it forced the federal government to pass the Displaced Homemakers Self-Sufficiency Assistance Act. This was a moment where the state recognized that the dissolution of marriage was creating a massive, untapped, and often desperate labor supply. This influx of millions of women into the workforce during the 1980s and 1990s did something unexpected to the U.S. economy. On the surface, it looked like a massive gain in productivity. GDP grew as more people entered the market. However, this period also saw the birth of what economists call the two-income trap. As more households transitioned to having two earners, the price of the basic components of middle-class life, specifically housing in good school districts, began to bid upward. The economy adjusted to the two-income baseline. By the time we reached the early 2000s, the dual-income household was no longer a luxury for moving ahead. It was a requirement for standing still. Divorce in this environment became an even greater economic catastrophe. When a dual-income household splits, they don't just lose their companionship. they lose the economies of scale that allow them to afford a mortgage that was priced based on 2 salaries. This leads us to a critical piece of the analytical puzzle: the professionalization of the divorce industry and the federalization of child support. Before the mid-1970s, child support was a localized, often ignored legal obligation. But as divorce rates climbed, the federal government realized a terrifying fiscal potential outcome. If divorced mothers could not collect support from fathers, they would end up on the government's welfare rolls, specifically the program then known as Aid to Families with Dependent Children. To prevent this massive drain on the federal treasury, Congress passed the Child Support Enforcement Act of 1975, creating the Office of Child Support Enforcement. This was a massive expansion of state power into the private family. By 1984, the federal government mandated that all states implement wage withholding for child support. Think about the economic mechanism here. For the first time in U.S. history, the government created a massive automated system to redirect the flow of private wages across household lines. This turned child support from a private moral duty into a multi-billion-dollar financial transfer system that directly impacted the disposable income of millions of American men and the survival of millions of American women. As we moved into the 1990s, the financial industry began to capitalize on this fragmentation. We saw a shift in how consumer credit was marketed. Under the Equal Credit Opportunity Act of 1974, which was fully maturing in its impact by the 90s, women could finally establish their own credit identities independent of their husbands. This was essential for the divorce economy. Without independent credit, a divorced person could not rent an apartment, buy a car, or secure a mortgage. This legal change allowed for the creation of the singles economy, where the financial industry could now target 2 smaller consumers instead of 1 large one. Data from this era shows an explosion in the marketing of credit cards and personal loans to single-parent households. Financial institutions realized that divorce created a period of high consumption as individuals had to restock their lives from scratch. This is the duplication of demand. 2 households need 2 of everything: 2 lawnmowers, 2 dining room sets, 2 internet subscriptions. While this is a tragedy for the individual's savings rate, it is a significant stimulus for retail and service sectors. The 1990s also introduced the concept of the divorce-driven housing sale as a major market mover. In any given neighborhood, a divorce often forces an involuntary liquidation of the family's largest asset, the home. Because these sales are often time-sensitive and legally mandated, they provide a constant source of liquidity and turnover in the real estate market. However, this also contributes to the erosion of intergenerational wealth. When a family stays together, the equity in the home stays in the family. When a family divorces, a significant portion of that equity is siphoned off by the divorce industrial complex. We are talking about legal fees that can range from $5,000 to over $100,000, real estate commissions, and moving costs. Case studies of middle-class families in the 90s show that a single divorce could effectively reset a family's wealth accumulation by a decade or more. The money that would have gone into a 529 college savings plan or a 401k instead went into the pockets of the service providers facilitating the split. But there is a deeper, more systemic shift occurring during this time that we see playing out in our current 2026 economy. This is the shift in the value of human capital. In the old model, the stay-at-home spouse was providing a massive, unpriced subsidy to the earner. By handling all domestic logistics, they allowed the earner to focus entirely on career advancement. Divorce ended that subsidy. For the man, it meant suddenly having to pay for the services his wife used to provide for free, like childcare, cleaning, and meal preparation. For the woman, it meant the sudden realization that her years of domestic labor had zero market value and she was starting at the bottom of the ladder. This realization fueled the massive push for higher education among women in the 80s and 90s. They weren't just seeking fulfillment. They were seeking a divorce insurance policy. This surge in female education changed the American workforce forever, leading to the current 2026 reality where women now earn more than half of all doctoral degrees and a majority of undergraduate degrees. As we analyze this history, we have to look at the psychological economic shift. By the end of the 1990s, the idea of a permanent economic union was being replaced by the idea of the individual as the primary economic unit. This has led to the rise of what we see today as the gig economy and the rental crisis. Why invest in a 30-year mortgage if you aren't sure your partnership will last 10? Why build a life around a single employer if the very structure of your family is fluid? This fluidity is great for a flexible, just-in-time labor market, but it is devastating for long-term capital accumulation. The 1990s set the stage for a world where everyone is a free agent, not just in their jobs but in their homes. The ripple effects of these decades created a fragile economic baseline that was about to be tested by the largest housing bubble in history. But while the headlines focused on subprime mortgages and Wall Street greed, a silent partner was driving the volatility behind the scenes. In Part 3, we are going to look at the 2000s and uncover a shocking correlation. How the peak of the U.S. divorce rate and the peak of the housing bubble were not a coincidence, but a feedback loop. We will explore how the credit boom of the early 2000s was fueled by people using their home equity as a divorce fund, and why the 2008 crash hit divorced households twice as hard. If you think you understand the Great Recession, wait until you see it through the lens of the broken marriage contract. The math is about to get much more intense. To understand how the math of the broken marriage contract gets more intense, we have to examine the decade that redefined American debt, the 2000s. While the general historical narrative of the early 2000s focuses on the tech bubble burst and the subsequent housing boom, an analytical view of the economy reveals that the housing market was being propped up by a very specific and volatile demographic driver. By 2003, the United States was seeing the full maturation of the dual-income baseline. Households were no longer just two people living together. They were two distinct credit profiles fused into a single financial entity. This fusion allowed for massive borrowing power, which banks were eager to exploit. Imagine a couple in 2005, let's call them David and Jennifer, living in a rapidly appreciating market like Las Vegas or Phoenix. In this era, the home was not just a shelter, it was a piggy bank. For couples like David and Jennifer, whose relationship might have been fracturing under the pressures of the modern economy, the rising equity in their home acted as a temporary marital stabilizer. This is a historical trend we call the equity buffer. When a marriage is struggling, financial friction is usually the primary accelerant. But in the mid-2000s, if you needed $10,000 to fix a car, pay off a credit card, or take a vacation to save the marriage, you simply tapped into a home equity line of credit or performed a cash-out refinance. The housing bubble essentially subsidized unhappy marriages, allowing them to persist longer than they would have in a stagnant economy. But this created a massive, hidden economic risk. These couples were over-leveraging their primary asset, assuming that the 15% annual appreciation would continue indefinitely. They were using debt to paper over the structural cracks in their household unit. When the music stopped in 2008, the collision between the housing crash and the divorce rate created a financial wreckage that we are still analyzing in 2026. This period introduced the phenomenon of the underwater divorce. To understand the brutality of this math, you have to look at the step-by-step process of a standard marital dissolution. Typically, the largest asset, the family home, is either sold with the proceeds split, or one spouse buys out the other's share of the equity. Imagine the situation in 2009. David and Jennifer decide to divorce. In 2006, their home was appraised at $450,000 with a $400,000 mortgage. By 2009, that same home is worth $300,000. They are now $100,000 underwater. In a standard economy, divorce is a liquidation event. In the 2009 economy, divorce became a bankruptcy event. You could not sell the house because you would have to bring a six-figure check to the closing table just to get rid of the asset. You could not buy out the other spouse because there was no equity to trade. This led to a historical anomaly, the divorce dip. Data from the Great Recession shows that divorce rates actually declined between 2008 and 2011. This was not because Americans suddenly became more happily married. It was because they were too poor to leave. We entered the era of the roommate divorce, where thousands of couples lived in a state of high-conflict cohabitation, simply because they were tied together by a toxic mortgage. From a macroeconomic perspective, this created a massive stagnation in the labor market. People who would have otherwise moved to a new city for a better job after a split were stuck in a house they couldn't sell in a city with no work. The 2008 crash also exposed the fragility of the Qualified Domestic Relations Order, or QDRO. This is the legal mechanism used to split retirement accounts like 401ks and IRAs. In the early 2000s, these accounts were seen as the secondary safety net. But when the stock market lost 50% of its value, the math of retirement division became a zero-sum game of survival. If a couple had $200,000 in a 401k in 2007, and it crashed to $100,000 in 2008, a 50-50 split no longer provided enough capital for either person to establish a new household. This is where we see the beginning of the retirement crisis for the older Gen X and younger baby boomer cohorts. The historical trends show that those who divorced during the 2008 to 2012 window saw a permanent downward shift in their wealth trajectory that most have never recovered from, even by 2026. Furthermore, the Great Recession fundamentally changed the gendered economics of divorce. The industries hit hardest initially were male-dominated, such as construction and manufacturing. This led to a surge in mancessions, where the male earner lost his job while the female earner, often in healthcare or education, remained employed. This inverted the traditional alimony and child support power dynamics. We began to see a significant increase in cases where women were the ones paying support to their former husbands. This created a new type of social and economic friction that the legal system was unprepared to handle. The breadwinner identity, which had been a cornerstone of the American marital contract for a century, was being dismantled by the cold reality of the shifting U.S. labor market. As the economy slowly began to recover in the mid-2010s, we didn't see a return to the old status quo. Instead, we saw the birth of the lean household. The trauma of 2008 taught a generation of Americans that the dual-income, high-leverage lifestyle was a trap. This led to the rise of single-income by choice or solo-living households, which have become a dominant force in the 2026 economy. Investors began to realize that the most stable consumer was no longer the married couple, but the single professional. This realization shifted billions of dollars in capital toward the construction of luxury studio apartments and the development of the subscription-based economy. If you can't rely on a partner to share costs, you rely on technology to optimize them. But there is a darker side to this transition. The fragmentation of the household unit has led to the atomization of wealth. When two people live together, they share the cost of heating a room, the cost of a high-speed internet connection, and the cost of insurance. When they split, those costs don't just double, they compound. In 2026, we are seeing the logical conclusion of this trend. An economy where the cost of being single is essentially a structural tax on the individual. This is why the rental market remains so tight despite fluctuating interest rates. We have more people than ever needing their own four walls, not because the population is exploding, but because the household unit is imploding. As we move into the next part of this masterclass, we are going to look at the most modern and perhaps the most controversial shift in this history. We are moving from the era of housing as an ATM to the era of the app as a matchmaker. In Part 4, we will analyze the dating app economy and how the gamification of human connection has turned the marriage market into a high-frequency trading platform. We will explore the shocking data on how Tinder, Bumble, and Hinge have actually impacted the U.S. divorce rate by lowering the search costs for a new partner, and why the tech industry is the biggest winner in the modern divorce cycle. If you thought the housing crash was a disruptor, wait until you see what happens when the algorithm meets the alimony. The commodification of the heart is the next frontier of the U.S. economy. To understand how the algorithm meets alimony, we must analyze a concept economists call search costs. In the decades preceding the 2010s, the economic cost of finding a new partner was high. It required significant investments of time, social capital, and often money, attending events, engaging in hobbies, or relying on a limited social circle. From an analytical perspective, these high search costs acted as a stabilizing force for the marriage contract. When the cost of finding a replacement is high, individuals are more likely to invest in their current partnership to resolve conflicts. However, the launch of Tinder in 2012 and the subsequent explosion of the dating app industry fundamentally shifted the supply curve of the marriage market. Imagine a character named Alex in the year 2026. Alex is 42 years old, living in a high-cost urban center like Austin, Texas. He has been married for 12 years. In a pre-app world, if Alex's marriage hit a period of stagnation, his exposure to alternative partners would be limited to his immediate physical environment. In 2026, Alex has a high-frequency trading platform for human connection in his pocket. The search cost has effectively dropped to near zero. This is the first major economic disruption, the democratization of the alternative. When the perceived market value of an individual is constantly being validated by an algorithm, the opportunity cost of staying in a struggling marriage appears higher than it ever was in the 1980s or 90s. Historical trends from the mid-2010s to the early 2020s show a fascinating correlation. While overall divorce rates in the United States have actually trended downward for younger cohorts, volatility within those marriages has increased. Economists suggest this is because the marriage market is becoming more efficient. In an efficient market, assets, or in this case partners, are reallocated more quickly to their highest valued use. The dating app economy has turned the American household into a more fluid asset. If the household is not producing the expected emotional or financial return on investment, the digital marketplace provides an immediate exit ramp. This brings us to the professionalization of the digital discovery process. In 2026, divorce is no longer just about splitting bank accounts. It is about the forensic analysis of digital footprints. This has created a massive new revenue stream for the legal industry. A typical divorce case for someone like Alex now involves the subpoenaing of data from platforms like Match Group or Bumble. Lawyers are now employing data scientists to analyze geolocation pings, swiping patterns, and direct message timestamps to build cases for infidelity or the dissipation of marital assets. Imagine the billable hours required to sift through 5 years of metadata. This is the new overhead of the divorce industrial complex. The commodification of the heart has created a secondary market in digital forensics that did not exist 20 years ago. Furthermore, we must look at the subscription model of the singles economy. Companies like Match Group and Bumble are not just tech firms. They are macroeconomic actors that thrive on the dissolution of the nuclear family. From an analytical standpoint, a married couple is a dead lead for a dating app. A divorced individual, however, is a high-value recurring revenue source. Historical trends indicate that divorced individuals are more likely to pay for premium tiers, boosts, and advanced filtering options as they attempt to re-enter the market with a sense of urgency. The 2026 economy has effectively monetized loneliness. When a marriage in a mid-sized U.S. city ends, it isn't just the local real estate agent who wins. It is the shareholders of the platforms that facilitate the next connection. Let's dive deeper into the case study of the post-divorce spending surge. Data from the last decade suggests that the 6 months following a legal separation represent one of the most intense periods of consumer spending in an adult's life. This is the replacement cycle. Alex, our 2026 character, doesn't just need a new apartment. He needs a new identity. This involves what economists call signaling goods. He spends on fitness memberships, a new wardrobe, and lifestyle technology to make himself more competitive in the digital marketplace. This spending is often fueled by the liquidation of marital assets. The equity that was sitting dormant in a joint savings account is suddenly thrust into the velocity of the economy. In this way, divorce acts as a recurring stimulus package for the retail and service sectors. However, this efficiency comes with a significant long-term cost to the U.S. macroeconomy: the erosion of household resilience. A single-person household is inherently more fragile than a multi-person household. In 2026, we see this in the rising demand for personal debt. Without a partner to provide a buffer against job loss or medical emergencies, the divorced individual relies more heavily on credit products. This has led to a surge in the fintech sector, which has developed specific lending products for the single-parent and newly divorced demographics. We are seeing a shift from the internal insurance of the family unit to the externalized insurance of the financial markets. Another critical factor is the impact of the algorithm on the marriage premium. Historically, married men earn more than single men, a trend known as the marriage premium. Analysts attributed this to the stability and domestic support provided by a spouse. But as the dating app economy makes the family unit more fluid, that premium is beginning to evaporate in the 2026 labor market. Employers are less likely to view marriage as a proxy for stability when the statistical likelihood of a disruptive divorce remains high. Instead, we see the rise of the unattached professional as the new labor ideal. Someone who is mobile, digitally native, and capable of relocating without the friction of a trailing spouse or a custody arrangement. This brings us to the concept of the divorce hedge marriage. In 2026, we are seeing a massive increase in the use of prenuptial and postnuptial agreements, even among the middle class. These are no longer just for the wealthy. They are seen as essential financial planning tools, similar to a 401k or a life insurance policy. People are entering marriages with an analytical eye on the exit. They are pre-calculating the cost of the split before the first anniversary. This legalistic approach to romance further accelerates the commodification of the partnership. It treats the marriage as a merger and acquisition rather than a permanent union. As the algorithms get smarter, they are beginning to predict divorce before the couple even knows it is coming. Data aggregators can now track shifts in spending patterns, travel frequency, and even the sentiment of social media posts to assign a divorce probability score to households. In Part 5, we are going to look at the terrifying intersection of big data and family law. We will explore how insurance companies and lenders are beginning to use these scores to determine creditworthiness and premiums. We will look at the rise of divorce insurance and how the financialization of marital failure has become a blue-chip investment strategy. If you thought your private life was off-limits to the economy, wait until you see how your relationship status is being traded on the back end of the internet. The math is moving from your checkbook to your cloud-based profile, and the stakes have never been higher. In the year 2026, those stakes are measured in petabytes of behavioral data that quantify the stability of your home life before you even realize it is under threat. We are moving beyond the era where divorce was a private legal matter and into an era where it is a high-value data point for the global financial sector. To understand this, we have to look at the historical trends of predictive analytics. In the early 2010s, retailers like Target famously demonstrated that they could predict a pregnancy based on changes in purchasing behavior, shifts in the types of lotion or vitamins a consumer bought. By 2026, that same logic is being applied to the dissolution of the American marriage. Imagine a character named Marcus, living in a tech-saturated city like Seattle. Marcus believes his personal life is separate from his financial profile, but the algorithm knows otherwise. The data aggregators that feed into credit bureaus and insurance companies have identified a pattern of spending, known as the pre-separation surge. This pattern includes subtle but statistically significant shifts: a sudden increase in spending on individual health and wellness, a change in grocery habits from family-sized portions to ready-made single meals, and a spike in geolocation pings at late-night fitness centers or solo entertainment venues. For Marcus, these are just lifestyle changes. For the financial system, these are indicators of an impending household fragmentation event. Historical trends suggest that a household in the process of splitting is a high-risk entity for lenders. In a dual-income-dependent economy, the transition from one household to two usually results in a temporary but severe liquidity crisis. If Marcus applies for a personal loan or a new credit card in 2026, his marital stability score, a submetric of his broader creditworthiness, might already be trending downward. Lenders are increasingly using these hidden scores to adjust interest rates or credit limits. They aren't predicting your divorce because they care about your relationship. They are predicting it because they want to mitigate the risk of a default that occurs when a single salary is suddenly forced to cover a mortgage designed for two. This has led to the rise of a controversial new financial product, divorce insurance. While previous decades saw this as a niche or even scandalous concept, in 2026, it is being marketed as a prudent risk management tool. Case studies of middle-income professionals show that the average contested divorce in the United States now costs upwards of $25,000 in legal fees alone, not including the liquidation of assets or the cost of relocation. Divorce insurance operates on an actuarial model similar to disability insurance. You pay a monthly premium during the marriage, and if the union dissolves after a specific vesting period, the policy provides a lump sum payout to cover legal retainers and the first 6 months of independent housing. From an analytical perspective, this is the ultimate financialization of marital failure. It turns the risk of divorce into a tradable commodity. Insurance companies are now some of the largest collectors of marital data, using AI to refine their premiums. If you live in a zip code with a high divorce rate, or if you work in an industry with high occupational stress, your premiums are higher. This creates a feedback loop where the very act of insuring against divorce further commodifies the relationship, treating it like a depreciating asset rather than a social contract. But the data doesn't just stay with the insurers. It has migrated into the courtroom. In 2026, the traditional divorce attorney is being supplemented, and in some cases replaced by legal AI platforms. These platforms use machine learning to analyze decades of case law, judge-specific rulings, and asset valuation trends to predict potential outcomes with startling accuracy. Imagine Marcus enters a mediation session. His AI-driven legal consultant has already run 10,000 simulations of his case, based on the specific judge assigned to the local circuit. It knows that this particular judge typically favors a 55-45 split of liquid assets if the marriage lasted more than 10 years but less than 15. It knows the exact percentage of alimony that is likely to be awarded based on the current inflation-adjusted cost of living in Seattle. This level of precision has turned divorce negotiations into a high-stakes game of data arbitrage. The party with the better algorithm has a significant advantage in the settlement process. This has created a new digital divide in the U.S. economy. Wealthier individuals can afford premium AI legal services that optimize their asset protection, while lower-income individuals are left with standardized, one-size-fits-all legal templates. This discrepancy is widening the wealth gap even further during the process of household dissolution. We also have to consider the impact of sentiment analysis on marital litigation. In 2026, your digital communications, emails, texts, and even voice assistant interactions are often indexed and analyzed for emotional volatility. In high-conflict custody or asset cases, lawyers are using AI to perform sentiment scoring on years of communication. A high frequency of aggressive language or a pattern of financial concealment detected by an algorithm can be used as evidence of marital misconduct or a lack of parental fitness. This means that the privacy of the American home has been effectively abolished by the economic requirements of the legal system. Step by step, we are seeing the transition from a fault-based legal system to a data-based economic system. The U.S. economy in 2026 thrives on the movement of capital, and nothing moves capital faster than a divorce. When Marcus and his spouse split, they will trigger a cascade of economic activity. The sale of a home, the purchase of 2 new vehicles, the establishment of 2 new utility accounts, and the payment of massive professional fees. In the eyes of the GDP, Marcus's personal tragedy is a net positive. This is the uncomfortable truth of the modern American economy. It is structurally incentivized toward fragmentation. But what happens when this fragmentation reaches its limit? What happens when the cost of splitting becomes so high that it creates a permanent underclass of people who can neither afford to stay together nor afford to leave? We are seeing the emergence of the cohabitation trap, where individuals are economically bonded to partners they no longer wish to be with, creating a domestic environment that is essentially a micro-recession. The mental health costs of this trend are starting to show up in the productivity data of the U.S. labor force, leading to billions of dollars in lost output. As we look toward the next part of this masterclass, we have to address the most significant byproduct of this historical shift: the children of the divorce economy. In Part 6, we are going to dive into the massive industry of child support 2.0. We will analyze how the state has turned parenthood into a collection agency, and the shocking ways that child support debt is being securitized and traded in the shadow banking system. We will explore how the next generation is being economically branded by the marital status of their parents, and why the zip code of your childhood home is no longer the best predictor of your future wealth, but the stability of your parents' bank accounts is. The math of the family is about to meet the math of the bond market. The math of the family meeting the math of the bond market is not a metaphor. In the United States of 2026, it is a structural reality defined by the massive automated machinery of the Title 4D program. To understand the current economic landscape, we have to look back at the historical trends that turned the American state into the largest collection agency in human history. This evolution began in 1975, but by 2026, it has reached a level of technical sophistication that treats human relationships as predictable cash flow streams. Under Title 4D of the Social Security Act, the federal government provides incentive payments to states for every dollar of child support they collect. This creates a powerful macroeconomic incentive for the state to keep the divorce and separation machinery well-oiled and highly efficient. Imagine a character named Jason in 2026. Jason is a mid-level project manager in Columbus, Ohio. Following his divorce 2 years ago, Jason's financial identity was essentially split into 2 separate ledgers. The first ledger is his traditional personal economy: his rent, his car payment, and his groceries. The second ledger is his state-mandated transfer ledger. Every 2 weeks before Jason even sees his direct deposit, the state's automated clearinghouse system intercepts a significant percentage of his gross income. In the 2026 economy, Jason's paycheck is a pass-through entity. He does not own his labor in the traditional sense. He shares it with a state-monitored escrow account. This creates what analysts call the garnishment economy. When millions of individuals like Jason have their disposable income reduced at the source, it has a profound effect on local consumption. Jason isn't buying a new car or investing in a specialized certification because his liquidity is capped by a legal formula that was designed in an era of lower inflation and different labor dynamics. Historically, child support was meant to ensure the well-being of the child, but in the 2026 analytical view, it has also become a mechanism for state fiscal stability. By ensuring these private transfers occur, the state reduces the potential outcomes of individuals falling onto public assistance. The child support system is, in effect, a massive private sector welfare program that bypasses the traditional tax system. Now, let's look at the intersection with the bond market and shadow banking. In 2026, the total amount of child support arrears unpaid support in the United States exceeds $100 billion. This is a massive pool of debt. While you cannot buy or sell a child support obligation on the New York Stock Exchange, the data surrounding this debt is highly valuable. Financial institutions and fintech startups use the payment history of individuals in the 4D system as a high-fidelity proxy for credit risk. If Jason misses a single payment, his internal stability score drops faster than if he had missed a credit card payment. Why? Because the state has enforcement powers that no bank possesses. The state can revoke Jason's driver's license, his professional engineering license, and his passport. In the 2026 labor market, which is increasingly dependent on mobility and professional credentials, the loss of a license is an economic death sentence. This leads to the paradox of enforcement. By revoking the professional licenses of non-paying parents, the state inadvertently removes high-value labor from the economy, reducing the very tax base and support-paying capacity they are trying to protect. Case studies from 2024 to 2026 show that license suspension policies often result in a net loss to the local GDP, as skilled workers are forced into the informal or underground economy to survive, where their wages cannot be garnished but also cannot be taxed. Furthermore, we must analyze the economic branding of the next generation. In 2026, we are seeing the emergence of the inherited credit gap. Children raised in multi-household economies often lack the concentrated intergenerational wealth transfer that occurs in stable, single-household units. When assets are split, the compounding interest on those assets is also split. Instead of a single, robust college fund, you have two smaller, competing financial priorities. This fragmentation has led to a surge in student loan dependency. Data from 2026 indicates that students from divorced households carry, on average, 25% more debt than those from intact households, simply because the household's ability to provide a cash flow buffer for education was halved a decade prior. This is the hidden tax of divorce, the loss of the household's internal insurance capacity. In a 1950s or 1980s model, the family acted as a mini-bank. If a child needed a down payment for a home or a loan for a small business, the family pooled resources. In the fragmented economy of 2026, that internal bank is often insolvent or closed due to the high overhead of maintaining two separate lives. This forces the younger generation to rely more heavily on external financial markets, which further extracts wealth from the family unit through interest and fees. Imagine if we looked at the U.S. economy not as a collection of individuals, but as a collection of household balance sheets. The 2026 balance sheet is deeply fractured. We have created a system where the state is more invested in the enforcement of the split than the stability of the union. This is not a moral judgment. It is a cold, hard analytical fact based on the funding structures of our legal system. The more people who enter the family court system, the more federal funding the state receives to manage that system. It is a self-perpetuating economic cycle, but there is a new disruption on the horizon that even the Title 4D program wasn't prepared for. As we move into the middle of this decade, the rise of decentralized finance and the gig economy is making traditional wage garnishment more difficult. People are moving away from traditional W-2 employment into 1099 contracting and crypto-based payments. This is creating a crisis for the state's collection machinery. The battle between the state's desire for automated collection and the individual's move toward financial sovereignty is the next major conflict in the history of divorce economics. As the state struggles to track income in a decentralized world, they are turning to even more aggressive tactics, including the monitoring of real-time transaction data. In Part 7, we are going to explore the rise of forensic fintech. We will look at how the government is partnering with major banks to create a real-time surveillance net for the divorced population. We will analyze the case study of the digital nomad and how the U.S. is trying to exert financial control across international borders. If you think your income is private once you leave the corporate world, you are about to see how deep the state's reach really goes when a support order is on the line. The hunt for liquidity is becoming global, and the technology involved is nothing short of science fiction. The next part of this masterclass will reveal how the 2026 border is not a line on a map, but a filter on your bank account. In the year 2026, the concept of a sovereign financial life has become a historical relic for anyone entangled in the American family court system. To understand why the border is now a filter on your bank account, we have to analyze the rise of forensic fintech and the total integration of state enforcement with global banking APIs. In previous decades, an individual could theoretically move across state lines or overseas to escape the reach of a support order, relying on the bureaucratic friction between different jurisdictions. However, the historical trends of the 2020s saw the systematic removal of that friction through the expansion of the Financial Action Task Force guidelines and the implementation of the Common Reporting Standard. Imagine a character named Leo. Leo is a high-level systems architect living in Lisbon, Portugal, in 2026. He is a digital nomad, earning a significant salary from a US-based tech firm, paid out in a mix of traditional currency and stablecoins. Leo has a standing child support and alimony order from a marriage that dissolved in California 3 years prior. In the 2010s, Leo might have successfully shielded a portion of his income by keeping it in a foreign account or a digital wallet. But in 2026, the US government has partnered with major global financial institutions to create what analysts call the Transparent Ledger Initiative. The moment Leo's employer initiates a payroll transfer, the transaction triggers a real-time compliance check. Because the US State Department and the Office of Child Support Enforcement have integrated their databases with the SWIFT network and major cryptocurrency exchanges,